This is the current federal tax developments for the week of December the 23rd, 2024. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. I'm Ed Zollers, and what we're going to look at this week will be a few developments that have occurred during this week before we start the big holiday breaks. First, we're going to talk about IRS releasing a modification to the automatic accounting methods that will allow automatic accounting method changes related to 174 research and experimental expenditures are now going to be extended to cover years beginning in 2024. We're also going to check in on the beneficial information report status. We had a very hectic week, but ultimately we're pretty much where we were a week ago. Now, this may change rapidly, and maybe, within a few hours of this going live, within at least a few hours of you guys listening to it on Monday. So pay attention. Things may have changed by the time you get here. We are definitely waiting on one court decision, which right now appears to be realistically the one thing that could still change whether or not reports are due on January 1st of 2025 for entities that existed as of January 1st of 2024. So we're going to talk about that and what also happened this week. The IRS released the mileage rates for 2025. So we'll talk about what those are and, get that updated. We also had finalization of regulations on the supervisor's approval of penalties. That's been an issue. We have 3 different U.S. Circuit Court of Appeals decisions with slightly different interpretations of the section in question. The IRS has now come up with their interpretation, which may or may not be accepted by those courts. So probably we haven't heard the last of this one yet. And finally, the IRS put out a pretty significant set of proposed revisions to Circular 230 on Friday. So we'll talk about what they're doing there. A lot of this is responding to court cases that they had lost over the last few years. In some cases, they are just conceding the case. In other cases, they're basically going to work around it or try to work around it. So we'll talk about where we get with all of this. But let's start with Revenue Procedure 2025-8. This was released by the IRS on December the 17th. And this is I think this is the 3rd revenue procedure we've had that's modified the automatic accounting method change revenue procedure that was released for for entities, businesses that had to change their method of reporting research and experimental expenditures due to the Tax Cuts and Jobs Act changes to Section 174. That took effect back in 2022, if I recall, in which in theory has been being tried to be repealed ever since. And so far, it's total abject failure in getting it repealed. So what this procedure will do will merely add that if you need to, you can make an automatic change for a year beginning in 2024 to come into line with required reporting for research and experimental expenditures. Now, this is true even if you've previously made such a request for change, it appears. I think a lot of that is because the IRS has had some modifications to their views. There's been some other things happen over time. So, in essence, 2024 is still available for automatic changes. There had been concerns if this was not done, that entity that found out in 24 they weren't conforming to the 174 rules properly could find themselves having to apply and pay for a IRS permission, straight up permission, not automatic. That would require an IRS ruling before you could file a return using the new position. The IRS did say that this particular ruling applies to change requests that are filed after the ruling was issued on December 17th. So it's in place now. But there's also provisions in the ruling that allow you to automatically change a prior changed consent, that you would ask the IRS on a 3115 to please rule if we can make this change at this point. There are methods just automatically change that over to an automatic consent, which presumably you would like to do. So it makes it a lot simpler. So in any event, not really surprising. I think a lot of the reason why we keep dragging this out is simply because the IRS is still thinking, well, Congress is going to repeal this, right? So we end up with lots of kind of things like this. And a lot of companies, honestly, are probably thinking, they're just going to repeal this thing. We'd have to go back and amend anyway. So But we are starting to get now enough years in, 2002, 2022, 2023, now the 2024 tax returns. We're enough years in, it is very, very possible that they will never change this. As I would say when I've talked in full day classes this year, it's like, look, the world hasn't ended, since we did this. Yes, I know it is very unusual. Yes, I know most countries don't do it this way. But Congress looks around, sees that nothing seems to have fallen apart yet, and so they just leave it. There's no rush to get this fixed. And certainly we don't have that. We are probably now just mere days away from, if not already at this point, to this formally falling apart. I didn't check to see for sure if the House and Senate have literally left town yet, or if they just were, kind of working on it. But I know, having gotten the continuing resolution passed, I can't imagine, if they're not out of town yet, that they will not be very, very shortly, which then means any action would have to take place in the next Congress. That will come in early January. And of course, then you'd have to start over with what passed the House back in January. So we are back to square one. So most likely, we're going to go through our third straight year of having to have 174 done properly on the returns, and run into issues with clients that we discover that, haven't ever made the change because they just assumed it was going to be reversed. And well, it's not going to be. At least it doesn't appear currently. We've tried a few times and failed. So maybe we have to start believing that it's just possible this thing's around for good. Now, in a week that had lots happen and nothing effectively changed by the time we were done, let's talk about the Beneficial Ownership Information Report and the deadline of January 1st, 2025. When last we talked about this, we had a U.S. District Court in Texas that had issued a preliminary injunction against enforcement of the Beneficial Ownership Information reporting rules on the Corporate Transparency Act, and did so on a nationwide basis, not just limited to the plaintiffs in the case in front of the court, which is what we had in the case that was done back in March that came out of the court in Alabama. So this, again, case number 4:24-CV00478. It is a case, Texas Top Cop Shop, Inc. versus Garland, United States District Court from the Eastern District of Texas. Now, this week, we did have a little something happen. We did get a memorandum opinion and order from the judge in that case. And this was the not totally unexpected denial of a stay of the injunction barring enforcement of the reporting rules. The Treasury, basically, Department of Justice did ask the judge to stay the order pending the appeal. Now, I think everybody pretty much knew when they asked that their chances were very, 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 very close to zero with the facts in this case. And I mean by that, I mean when the judge went in and did an analysis about why there would be significant damages, in his view, to the plaintiffs in this case that justified, having the order come down immediately, and that those damages would affect pretty much nationwide. We had the whole back and forth. He didn't necessarily go as deep in the national order as maybe you might expect he should have, but still was not expected he was going to reverse. And hey, guess what? On the 17th, he didn't. So he denied the request to stay it. Now, that doesn't really affect things terribly, because separately from this request to the district court judge that issued the order, the Department of Treasury filed an emergency request with the Fifth Circuit to stay basically stay the injunction. And that has now been moving forward there. The Fifth Circuit basically put together a very, very, very condensed time frame for which basically the Department of Justice filed their, detailed, petition for relief. They gave a very short time for the plaintiff to file their basically rebuttal, and then the Department of Justice to effectively answer that one back. All filings were due by Friday, not Friday, say Thursday. Thursday at the end of the court day, all filings were due. It appears they all were filed. However, we did not get a decision on Friday. Some people had been suggesting that they were doing it this way, so they'd rule on Friday. However, it is very, very likely we will have a ruling this week. Now, why this case is important is because at this point in time, we'll talk about one other thing that happened this week, but at this point in time, this appears to be the only direction from which in essence, the only way that we could end up with a January 1st, 2025 filing obligation would be if the Fifth Circuit were to basically grant the stay request. Now, I suppose it is possible, although really we're in a bad time of year to get this stuff done this quickly. It's always possible that if the Fifth Circuit turns them down, that the Department of Justice could go to the Supreme Court and attempt to get it reversed before January 1st. But again, we're running into a severe time constraint, especially if the order does not come down Monday or Tuesday, and we're looking at Thursday or Friday for this ruling to come down. That'd be a very, very quick turnaround for the Supreme Court to rule. And at that point, it'd be almost impossible, right, for individual taxpayers to discover they now needed to do it and get it filed if they had heard, because they've all heard by now, at least a huge chunk of them, that, oh, we don't need to file this. So I think even if the Fifth Circuit grants the stay at this point in time, there are going to be a lot of people that don't timely file, and not just ones that, decide I'm not going to do it. Always be some stubborn groups in there, but also ones who now seriously think that the thing's been decided and they don't ever need to file it. So yeah, that all gets interesting. But it looked like for a while we could kind of moot this for a year. What happened, and in the end, this did not come forth, and I know some of you probably heard about this, so I think we need to discuss. In the original proposed, basically, continuing resolution that was going to be, extend basically the government's ability to pay bills through March, there were a lot of additional provisions tacked on to it. Now, a couple of them were, to add spending for certain farm programs and to add about $100 billion worth of relief for disaster relief issues for more recent disasters, including the hurricanes down in Florida, all of those neat things. So they had all of that stuff that was set to go in the bill. Now, as you probably heard, at 4 a.m. On Wednesday, get my dates right, I believe, Elon Musk, who is, and I tried to find an official title for him on that Doge or, whatever panel. All I ever see is leader. So I don't know there's any official. It's not like chair or whatever. We just have two leaders of that panel. But he came out and essentially said that, absolutely that bill as drafted, which was 1,547 pages. I know that because I had to go through the darn thing to verify that this pushback date was in there. It should not be passed, and any Republican congressman that voted for it essentially should be targeted in the primary. Okay, and then following that up later in the day, the president-elect essentially agreed with, basically the opinion of Musk at that point. But then he added another little caveat that he also wanted the debt limit ceiling to be essentially removed, as part of this as well, to get rid of that, because there's a fight coming up over the debt ceiling. Essentially, our temporarily suspension of the debt ceiling ends at the end of this year. Now, that doesn't mean they have to act on the 1st of January. They don't. In essence, it can be managed for a while. But it does mean there is a fight coming up over that here shortly. Unfortunately, it turns out we're not quite sure what would have happened. I mean, the primary concern of it appeared Elon Musk was, the spending that was being tagged onto the bill. And then also he called it a Christmas tree, which was all the other provisions on it, which, by the way, includes the pushback of the due date for entities that were in existence on January 1st, 2024, from January 1st, 2025 to January 1st, 2026. So that was part of the Christmas tree part of the bill. And, but he was then also concerned about the, $110 billion worth of spending that wasn't being offset, et cetera. So he was suggesting that this thing should just, the government go ahead and shut down, whatever they had to do, et cetera, was the move. Well, as I said, the president-elect added the issue. Yeah, I agree with him. And also absolutely got to have this debt ceiling. Getting out of there, get rid of it. It's just something that we shouldn't have to deal with. So he wanted that cleared too. Now, that turned out to be, as you know from previous debt ceiling raise numbers, that is, shall we say, an unpopular thing to vote for among many, many, many conservative Republicans. So what happened at that point was they tried to bring the resolution that met the requirements outlined by, Elon Musk, and then add the president-elect's requirements to the resolution. That went to the floor. Because it was going to the floor in a suspension of the rules, it had to have a 2/3 vote majority. Not only did it fail to get a 2/3 majority, it failed to get anywhere near a majority. Getting, I think, with 38 Republicans out, it was like 174 votes in favor. You needed, what was it, 100 and whatever it was, 208 or 218 in favor on the floor with the number voting. That had been just for majority. For 2/3, you had to be, higher than that. And obviously we weren't close. So it went down in flames on Thursday. Friday, they did come back late with another bill. This bill was a, quote, straight continuing resolution, just keep spending through March at the current levels. But it also added those two spending provisions with no offset. The $10 billion for the farm programs, $100 billion for disaster relief. Did not add back any Christmas tree provision, which includes, did not add back the extension of the filing deadline for the requirements for the BOI reports. So if you heard about that, you thought, oh, well, that's it. It won't be a problem. It's going to be, no, it's not happening. And, like I said, they are either out of town now or will very quickly be out of town. So, absent a total miracle, we are not getting a congressional action on this before the January 1st date. Therefore, as I said, keep your eyes on what's going on in the Fifth Circuit, because that's apparently where everything's going to happen, if anything does. The standard mileage rates were published by the IRS, notice 2025-5 on December 19th, right? These are the annual updates of rates. We always get those, and we get them just before the beginning of the year, so this is normal. And yes, the notice is 2025-5 because it's going to reach the Internal Revenue Bulletin in 25 when it's published in the IRB. Now, I know most of you may not even know what the IRB is. We did used to get those mailed out to us. I remember getting them, when I was in earlier in my career, they used to get those every time they got published. They'd give you the new IRB whenever it published. I think it's a biweekly schedule. In any event, you'd always get the paper copy, and that's where you'd find revenue rulings, revenue procedures, and the like. And back in those days, that could often be the first place you know about the being released. But in reality, they get approved and they kick out and get sent to all the publishers on the date they're approved. And then they will get in the IRB, and generally they're not effective until the IRB date. But in this case, it really doesn't matter. They're going to be retroactively effective, since these are just, the amounts that you can elect to do under standard mileage rates. And so from the accompanying IRS news release, which is 2024-312, because news releases don't get published in the Internal Revenue Bulletin. That's a 2024 news release. The amount for next year, for 2025, will go up to 70 cents per mile. That's up from 67 cents per mile for business use that we had in 2024. Medical purposes stays at the 21 cents per mile. That's statutory. Same for moving purposes for qualified active duty members of the armed forces. Again, remember, for the most part, moving expenses aren't deductible. There is a special exception for qualified active duty members of the armed services. So they're really the only ones that can get that these days. But, Now, in 26, in theory, that could change, but we're not talking about 26 yet. 14 cents per mile for charitables. That's also statutory, doesn't change. So we have that. The maximum vehicle cost for for the FAVR plans for employers, fleets are $61,200. And for the fleet average valuation rule and the vehicle cents per mile valuation rule, both under regulation 1.61-2, the maximum fair market value when the vehicle is first made available to employees is $61,200 for 2025. So if you need these mileage rates, and usually, clients do, you now can tell them it is 70 cents per mile. That's a new mileage rate for 2025. We also have final regulations issued here. Treasury Decision 10017. This will be Treasury Regulation 301.6751B-1. It came out on December the 20th, 2024. Now, I probably should give a caveat before we go forward. In the past, incoming administrations have effectively put on hold regulations that went final in the last 60 days of the prior administration. So while this is officially final and published, keep your eye on whether we have a suspension again. So it might take a little longer for this to go final than you might, than otherwise be normal, but it's still there. So I'm mentioning that. I'll go on here. This regulation seeks to clarify the application of 6751B's requirement that supervisory approval of proposed assessment of penalty must be received for a penalty to be assessed. Now, that's become a big issue and complicated a lot of cases. But a problem we have is there are 3 different U.S. Court of Appeal decisions from 3 different, basically courts of appeal that have arrived at 3 somewhat different rules here. Okay? The first one that got all this kicked off was Chai versus Commissioner from the Second Circuit in 2017. In that case, the Second Circuit said approval must be obtained before the date the notice of deficiency is given to the taxpayer, or the IRS has filed an answer asserting the penalty in tax court. Whichever one of those, it's got to be before those dates. Now, in the later case, the 11th Circuit only required approval before the penalty is formally assessed. That gets you way later in the process at that point, right? So we could be there. And the 9th Circuit, and that was a Kroner v. Commissioner case from the 11th Circuit in 2022. As well in 2022, we had the Laidlaw's Harley-Davidson Sales versus Commissioner case. In the 9th Circuit, that ruled that if it was for an assessable penalty, the approval must be given while the supervisor has the authority to change or disapprove the penalty. That's your test. As long as they have the ability to change or disapprove of the penalty, they don't need to have approved of it. So those are obviously 3 very different rules about how you make this work. So the IRS went and issued final regulations. Now, in the final regulation, there are really 3 different rules internally on this. For a pre-assessment notice, where the IRS can, after receiving this notice, they can petition the tax court to review it. The date that needs to be provided approval needs to be given is no earlier than the date the notice was issued to the taxpayer. For penalties raised in tax court after a petition is filed, the approval can be obtained before the IRS asks the court to determine the penalty. And finally, if penalties may be assessed without the taxpayer having prior opportunity to have the tax court review the penalty, approval can be obtained anytime prior to assessment. So essentially, these are our 3 rules that you'd operate under for these penalties. Now, this will apply to penalties assessed on or after December 23rd, 2024. So that'll be that's officially the date published in the Federal Register. So effectively, as of this week, these rules would apply. Again, this is one of those, keep an eye out for the income administration to potentially want to put this on hold. So we could find, sometime later next month after the inauguration, that this suddenly goes on hold. If I remember 8 years ago, I believe that was one of the first orders that he signed after he finished, his inaugural His inauguration was over, the parade, etc. All that was done. He went back and signed orders to put these regulations on hold pending review. So, and I think Biden did something very similar 4 years ago. So, yeah, don't be surprised if this takes a little while to go in. Doesn't mean it won't go in, because it's going to depend upon whether, the new administration has problems with this or not. And I'm sure everybody that doesn't like this is going to be telling them what they don't like, because there definitely are people that aren't thrilled with this particular rate. So we'll just phrase it like that. Now, probably the biggest thing of this week came up late on Friday. This is Regulation 116610-20, which is a proposed rate issued on December 20th, 2024. And this is meant to revise the regulations that we refer to as Circular 230. In case anybody doesn't know what Circular 230 is, it represents the regulations that the Treasury has issued, final rules regarding the Treasury's right to regulate representation before the IRS by CPAs, EAs, or should say CPAs, attorneys, and others, and those others became known as EAs, enrolled agents. And Circular 230 has various rules. You can be disbarred or suspended from practice before the IRS. It has a number of different provisions in it. It also has the best practices section. We'll talk about a little bit of that too. But the IRS had tried to do things with it, starting back around 2007 and moving through essentially much of the last decade. And they didn't necessarily have as much success in court as they might hope for. So there are provisions now in Circular 230 that we know the government's already said that no. They agree they're not going to challenge the court on the issue, so they're not going to enforce provision. So this is to a large extent a cleanup. It's aimed to update, and the term align with current law means you got to take into account the cases that have not gone the agency's way. Basically cases like Ridgely versus Liu, cases like the Loving case, etc. All of those cases, they're now going to take those into account. Now, as we'll discover, in some cases, they're going to take, like Loving, for the most part, just gets accepted, with only a minor adjustment to attempt to save the preparation standards in cases where the preparation is directly linked to a representation of a taxpayer before the IRS, not just preparation by itself. Other cases, as we'll discover with contingent fees, they're going to just try a whole in run to be able to get the same result, even if they're not regulating. They're not going to claim to be attempting to regulate preparation. They're going to instead be looking at dealing with the question about whether the taxpayer, whether the person has the right moral character. They have the right to make sure, to determine, whether or not somebody is morally capable of representing for the IRS. And so they're going to backdoor it through that. We'll talk about that here in a second, right? Now, they do make it very clear that the scope of this is limited to practice before the IRS. That was it, because last time, as I said, the previous version, or I would say, pardon me, the one we have now, which, this thing's not final yet, so we still got the old one. The one we have now has a lot of discussion about things beyond simple practice before the IRS, which generally is when you're on a power of attorney and you are able to, actually represent the client with an IRS notice, things like that, because you're operating under power of attorney. That would be practice before the IRS. The document also withdraws the notice of proposed rulemaking that was published in July 28, 2009, because that was trying to extend things that the Loving case essentially already said you went too far already. So those proposed changes back from 2009, they never were finalized. And now what the IRS is doing is simply getting rid of them for good. IRS is saying, yeah, we're not, those are never going to become final. We have now formally withdrawn them. So that's where we sit. One thing they're going to do is talk about the major topics here. And I do have an article on the currentfederaltaxdevelopments.com website that goes into each one of these in detail. So if you want the actual citations, point by point, section by section of Circular 230, each of these are found, it will be in that article. You can take a look at it. I also have, for most of these provisions, I've also reproduced the actual amendment, what the new section would say. They got rid of regulations related to registered tax return preparers. These rules were eliminated due to the decision in Loving versus United States, where, the D.C. District Court ruled that the IRS had no authority under the provisions that created the, now the Office of Professional Responsibility, but their regulation of basically representation before the IRS did not extend to regulating preparation of a return. That was not, in the view of the court, basically representation before the IRS, right? So references to RRTPs was also removed from a whole series of sections in the code, right? Took it very straightforward, said we're getting rid of those, right? We also had revision of the standards for tax return preparation throughout Circular 230. There were many things that talked about if you prepared a return, you had to meet certain requirements. Again, Loving Court says flat out, IRS, you cannot regulate the preparation of a return via Circ 230, right? That's it. Preparation of return is not covered by that grant of authority. So what they did here was they limited these tax return preparation standards. They keep them in the Circ 230, but they're now very clearly limited to returns prepared, approved, or submitted when you are representing a client before the IRS. So let's say, for instance, you get an exam notice, you pick it up, you start taking a look at what the client did that year, you discover that, we're wrong, whatever. Then these rules would apply to you as, let's say, you were preparing an amended return to offer up, before the exam got started. These rules would apply to you. They also would apply if you're preparing later returns for approval, things like that. The current rules related to tax return preparation that were found in Section 10.8 are eliminated, and a new Title 10.8, Participation in IRS Proceedings by Non-Practitioners, is added there. So we'll deal with that. Now, diligence requirements are also limited to returns prepared when representing its client before the IRS. There are due diligence rules and all of those things here. Now, we should be aware of that, right? And the standard for tax return positions apply only when representing a client before the IRS. All of that is true, but let's step back for a second if you're a CPA. The statements on standards for tax services has virtually identical rules in those areas as to what we used to have in Circular 230. So as such, not really going to change if you're a CPA. You're still going to essentially be under those rules for this point. So yeah, we're going to kind of do it. And those rules would apply if you are representing a taxpayer, before the IRS, then those rules still apply to any returns that you're dealing with at that point in time. So yeah, we pull those back. Probably doesn't really majorly impact the CPA, probably doesn't majorly impact EAs and what they'll be doing. Because again, while these rules may not impact in that area, the 6694 penalties do, and we're going to discover the IRS is going to backdoor tie those penalties into Circular 230 as well in a different manner, but we're going to get there. Now let's talk about the contingent fee problem. The IRS flat out, Section 10.27 of Circular 230 is simply going to be removed. That's the part that essentially banned a practitioner from accepting a contingent fee in most cases. And it became stricter. For many years, that section simply said that you couldn't accept it for an amended return, etc., unless you believe that the IRS would, devote substantial resources to the review of that. Now, the IRS changed that later to get rid of that exception, largely because they said that, practitioners were just assuming every one of these would get substantial review, when, let's face it, real world, we know a lot of amended returns just get processed. They don't get a lot of detail, a lot of attention paid to them. So they tightened that up. Well, when we got to Ridgely versus Liu, The court again held that in Ridgely v. Liu, that essentially, you're not able to, in Ridgely v. Liu, they can't regulate this because this is part of the preparation. So because the current rule prohibited contingent fees for tax return preparation in most matters for the IRS, 10.27 as written now is eliminated. So basically, and claimingly to come into line with Ridgely v. Liu. However, don't think that this really changes anything because we have to talk about a secondary change on contingent fees. We are going to find out now that the IRS is going to define accepting contingent fees of the type they didn't like will automatically be disreputable conduct. I'll get that right. Disreputable conduct. So what they're saying is if you do this, right, that's considered to be, disreputable conduct, and that would disqualify you basically from this sort of moral perspective of being able to represent clients for the IRS. So charging a contingent fee for preparing original or amended tax returns or claims for refund or credit is disreputable conduct under Circular 230 once this is finalized. That means, of course, that, the IRS then justifies saying it is disreputable conduct because they say that such arrangements encourage aggressive tax positions, in order to achieve the most personal gain for practitioners. The idea being that you would take a very aggressive position because you know that you're getting, let's say, 30% of the refund. You take a very aggressive position, and you know that the IRS does not have the staffing to be able to review all of these. So it's a really good chance your refund gets paid with nobody looking at it, and you'll get your 30%. So you can go, the theory of that being you can go very aggressive and still not likely get the service to question your refund claim. And of course, the IRS says, well, that's bad form, right? They also point out that now their rule is not dependent on the preparation of a tax return constituting practice, being practiced for the IRS. They're saying the fact you have a history of, or you have now at some point prepared a return for the contingent fee, that indicates that you have engaged in disreputable conduct, and that you don't have therefore the ethical background, the ethical makeup that would allow you to practice before the service. It's fairly blatant what they're doing here. Now, I should point out similar rules are included in the AICPA Code of Professional Conduct, although it still goes back to that old theory of if you believe there will be sufficient review at the IRS level, then you could charge a contingent fee. So they kind of glance over the fact that it had the old version of the rule that they weren't thrilled with, but they still point out that, and they point out as well that many state accountancy board rules prohibit receiving such contingent fees as well. And they're using that to justify applying this to not only CPAs, but EAs and attorneys in the same realm for this, okay? EA changes, couple of changes for enrolled agents, one of which you will no longer be able to become an enrolled agent simply by having worked at the IRS, right? There have been the rule there for a long time that if you had basically worked at the IRS and they determined that you had enough, that your experience was such that you should be considered the equivalent of an EA that took the exam, that they could grant you that status without needing the exam. The IRS said to justify this that it takes way too much time the agency doesn't have to determine if a former employee has the qualifications to meet this. So basically, from this point forward, once this gets finalized, IRS employees will have to still take the enrollment exam in order to become enrolled agents. They can't just get it from being at the IRS. Also, no longer will the IRS necessarily going to issue a registration card if you pass and become an EA. They're simply going to issue some sort of confirmation document, but it will not need to be the card. We're going to change that as well. And there are minor clarifying corrections, EA renewal process, but doesn't really change anything substantive or substantive. So basically, yeah, there is that there if you're an EA. On knowledge of error or an omission, this is some clarifications. They remind you that under the current Circuit 230, if you discover you're a practitioner, you're a Circuit 230 practitioner, and you discover an error, bit of non-compliance or an omission with a tax issue for a client you pick up, that you, of course, have to advise them that they're in violation and recommend certain corrective actions. What they're going to clarify in this case, because some people apparently thought that, if I didn't do it, then I don't need to say anything about it. They're going to say you have to notify the client whether you made the error, right? The client made the error, or another practitioner made the error. It doesn't matter. If you become aware of essentially some sort of error on the prior returns, something they're doing tax-wise, you got to step up and tell them about that. You can't hide behind the fact, well, I didn't do that return. That would not be a defense under this reg. Also, they add the standard line there. If a client refuses to take corrective action, you must consider whether you want to continue. That was in the old version as well. As a practical matter, that's there because, you're going to be forced into a bad position if you keep representing the client who doesn't want to fix something. Most importantly, if an exam comes up. That's a big problem because now, if you get asked about that, you can't lie to the agent, but you can't reveal. That means you're going to resign with no explanation to the agent. It'll take long for them to figure out what that probably means. So we have that issue. So, be aware of that when we do it. Also, if client refuses a corrective action, remember, when you're preparing later returns under Circular 30's requirements, under the statements on standards for tax service requirements, you can't perpetrate the error. You can't continue it into future returns. So, you basically, if you're preparing the return for 25 and there's an impact, let's say an NOL carryover because of a deduction that they took, let's say 6 years ago, that's just now making it on the return and allowing us to reduce our income. If that was true, you just can't essentially, if the client doesn't want to fix that, now you got a problem because you can't really do the current year's return. Because they're going to say, oh, take the NOL. Well, I can't, right? I have this problem. And so that's a big one in that area. Also coming up is now the IRS made changes to the best practices section in Circ 230. Right. Now, one thing they do throughout this, you just got to get used to it. They're going to replace tax advisors in the best practices section with tax practitioners. That's the more general term. It's used more often in Circ 230. They have decided now that calling them tax advisors in this part of Circuit 230 just confused issues. So they're going to go and put tax practitioners in. In theory, that adds nobody to your list, right? They just have to, they're not added to, all of those little issues for best practices. They're just there. It's how it works. So also, they say best practices include that you should have a data security policy and a breach response plan. Those are both considered to be best practices. This is one of those things where we already know the IRS has suggested multiple times. This just makes it clear. And the real problem with the best practices bit is this is set up perfectly for a plaintiff's attorney who is suing you for a client. These are the best practices per the IRS. A firm should follow these. Why didn't you? Especially if it turns out that they're going to argue, had you followed this policy, then some sort of damage would not have befallen their client. And therefore, they're going to ask you to pay the damages that resulted from that. So you want to make sure, that you understand and you document these policies, and probably you should have one for every one of these, what's there. Yeah, they also suggest, this probably goes with the aging of the practitioner population, that you need to address mental impairments that could affect a practitioner ability to represent clients. That's a best practice for a firm. That means you need to be watching out for and reacting to any evidence you see of a practitioner in your office potentially having trouble with substance abuse. Could it be alcohol, drugs, whatever? Having issues with potential just lack of mental acuity. They are beginning to get down to areas where you're beginning to worry about it's an Alzheimer's situation potentially developing, etc. The firm has to have a way of identifying that to protect the clients. All of those things should be involved. So you need to, in essence, you need to catch a practitioner who, let's say, for reasons that aren't really their fault, are nevertheless kind of, slipping away. So we need to be able to be aware of that and find it when it's there. Also, best practices are to make sure you have a business continuity plan in case you should die or you should decide to close your practice, what's going to happen to your clients, and a succession plan. That's kind of how we finish up. How are we finishing this? What happens when the current partners of the firm retire or die? Is there a plan to somehow, get the client serviced? And that's also, I suspect, becoming a bigger problem, both because the profession's aging and because, as you're aware, there is a real shortage of, qualified tax CPAs to step up. So a lot of clients are suddenly discovering that they're being left in the lurch because their CPA either died or simply retired. And there is nobody to send them to. So that's there. As I say, the concern with best practices is if you don't have one of these, a client who's claiming he's damaged because you didn't is going to point to that and say, well, the largest national organization, CPA, says you should have had this. Why didn't you? Technological competence. This is an ad in here. There is a standard requirement, Circ 230, that you must have competence to undertake the engagements, tax engagements you take. But now they're going to say that competence includes continuous maintaining of a familiarity with the technological tools used to represent the client. And they make it very clear that you, personally, the practitioner, remember this doesn't say the firm, it says practitioners must understand the risks and benefits of the technology they use. This is non-delegatable. You can't delegate this to somebody else, so my IT person takes care of that. No, not how this works. Whatever happens there, it's fine, but now your IT guy is not going to solve this problem. So be aware of that. It is one of those things to be aware of with technological competence. There were some minor changes to the written tax advice section in the regulation. It still uses the principles-based standards for written tax advice. It's not rules-based, but general principles-based, like we've had before. We did amend the definition of federal tax matter to include transactions or arrangements that have potential for tax avoidance or evasion. Bit broader than before, but that would be considered federal tax matter, for which you might be considering written advice. And it also clarifies the reasonable practitioner standard, which is what we test to see if you've given proper written advice. It also includes a consideration of the practitioner's knowledge of a client's particular circumstances. Now, this is raised in the context of opinions that are often written for tax shelters. The question becomes, what's the issue here? What we need to worry about here in terms of giving good written tax advice if we don't know the particulars? If this is going to be like a generic letter going out to everybody, we don't know the particular tax situation of any, or at least the vast majority of the buyers of this stuff, the people that invest, that could get you in trouble, right? Because especially if, as is often the truth, those particular facts about that client are crucial in figuring out whether or not you're going to be able to get the tax benefits that are being promised. Incompetence or disreputable conduct. This is the basis for sanctions. It's separate from all other provisions. It includes willful actions. which would include, failure to follow federal tax law or assessment for penalties related to tax avoidance. Those are things that would now be incompetent, along with accepting contingent fees. All of those comes in here. Now, they also have a clarification here. This was one that they now had to state because of a case that came down in Nevada called Sexton versus Hawkins, 1919 AFTR 2nd 2017-1187, came from the Northern District of Nevada, or District, I should say District of Nevada, not Northern, but District of Nevada, a 2017 case. There, the court had ruled that, once they're suspended, they're no longer under the jurisdiction of the IRS for these sections. And so, therefore, the IRS could not look and cannot use, essentially, the rules in case here to take action against them later if they violate. And that would include, whether or not they've in active suspension, are they doing things like holding out, not telling people they're suspended? According to the court, because they're no longer under jurisdiction of them, the agency couldn't investigate and take any action. Rather, you'd probably have to wait, presumably, for somebody to be harmed by them, discover they, basically were, they were barred from practice and were suspended from the IRS and or suspended from representation for the IRS. And so really couldn't solve the problem the client needed. That's going to be where they'd find it. Now they're going to say, nope, we're going to go back here and say, you've got to restore a license. And if you want to do any additional work that is kind of like, what we've been allowed here, in that case, fine. You go out there, you get that done. If you're out there and you're not telling people you've been suspended, then the service has a right to take action against you. Now, these regulations would take effect 30 days after the publications in Final Fund Federal Register. The comments on these regulations are due by February 24th of 2025. Right? And the income administration, as I noted, and or the new IRS commissioner could have an impact on these regulations. So keep your eye on all of those things. Again, with the change in administration, we may see some changes in regulations. And certainly we may see some actions taken on regulations that were put through in the waning hours of the Biden administration. So keep your eye out for both in that case. This has been the current federal tax developments for the week of December the 23rd, 2024. As always, this is brought to you by Kaplan and your state society CPAs. My email address, edzoller's currentfederaltaxdevelopments.com. If you have any questions. You also can find me on the Connect sites for Arizona, New Jersey, Indiana, Idaho, right, and to a certain extent, Washington and Illinois. So if you have questions, you can also post them there, and I will try to help them, and some others will probably chime in too, which could be very helpful if you've got it. Otherwise, hopefully you're all taking it nice and easy for the next couple of weeks. I know a lot of you are probably going to be going off visiting family, and doing things like that over the next few weeks, next couple of weeks. So I may not see any of you guys back until sometime in January, when hopefully we will know if we should have filed BOI reports or not. We'll see what that report works out. If you are going to be around this week, we should have another update for you a week from today, the final update of 2024. We'll run that and let you know what we know about anything that's happened. My guess is not much is going to happen this week, except potentially the Fifth Circuit ruling, just because I suspect a lot of IRS employees are going to be on vacation this week. And, I'm sure. And then also until late on Friday, it looked like nobody might be getting paid on Monday. So, yeah, it'd been a real question as to whether anybody would have been showing up anyway. So I'm not betting a lot's going to happen in the next week, but we'll see. If the Fifth Circuit comes down, that could be big, and we'll keep an eye out for that. But otherwise, we will look forward to seeing you, if not next week, then in early part of 2025 here on Current Federal Tax Developments.